Hey everyone, welcome back to the Mark Loeffler Experience. Today we're going to be going through how I'm investing in the stock market today, what it looks like, how you can do it. And well, pretty well my targets with that type of investment as of today. And I know you're gonna say, Mark, well, what the hell are you investing in the stock market for? It's like really down. Even if it goes sideways, I think most of the stuff I'm picking up right now or buying or looking at is gonna go sideways for a while. And you're like, well, why would you wanna buy a sideways stock? Well, the strategy that I'm using is I'm writing covered calls on dividend stocks. So I'm buying something like Intel, which was yesterday $26, now it's $27 and something. It went up, I don't know, a whole bunch today. Once it goes up like this, I will then write a covered call, really to boost my cash on cash return on my portfolio. Now, obviously, there are risks to this. In a market where, like, if I had sold a covered call yesterday on Intel, well, I might risk being called away at some point. But I'm selling covered calls for 2 months away, so therefore it can go up and down and do whatever in that time, and maybe I get it, maybe it gets taken away, maybe it doesn't. If it's going down or it's a flat market and I'm selling covered calls, I'm really just making extra money because they're paying me for the right to buy my stock at a certain price, right? So I'll walk through the numbers. And I'm still collecting the dividends on this, so we're gonna go through Intel and how that looks. So the basics of this. So if I want to do this strategy, I have to own 100 shares of a certain stock, because every call option I sell is going to be one call option is 100 shares. And again, if I sell that call option, that person has the right to buy that stock at that price anytime between the date I sell it until the expiry dates of that option. Pros and cons. In a market where the prices are going up stupid, the shares could just get called away, which means they get taken away at the price that you've put it. So you're limiting your upside, right? Which again, I have my certain targets. As long as I hit those targets, then I'm doing okay. So this works again. If it's in a crazy bull market and prices get too inflated, you're going to get crushed with this strategy, right? If it's in a market like today, it's actually not that bad. But as long as you can find decent stocks to pick up at various times, so like what? COVID was happening, all the tech stocks were going, but oil stocks, which are good dividend producing stocks, were in the tank because nobody was driving, right? So, you picked up Suncor, Enbridge, those types of things that still had good dividends, and you could write covered calls. So basically what I do is I buy the stock and I pick my target sale price. So we'll go to Intel, because that's what I'm really watching right now. And right now the stock is $27.67. So if I bought 100 shares of that, like what's my cost? $2,700, so call that $3,200 Canadian. And I'm looking out 2 months. So the dividend on this is paid on, I think it's February 6th. Yeah, February 6th. So on February 6th, I am going to make on my $27.65 a quarter of $1.46. So what the heck is that? 36.5 cents. So I'm going to make 1.4%-ish, about that, 1.35%, just on the dividend, right? So I make my dividend, I'm going to buy this stock and make my dividend. And then I could just go ahead right now and today sell a call option for, say, 2 months out at, what, $32.50 for 43 cents. So I could then go ahead and, like, that's another, what, 1.5%? So I'm going to get paid 1.5% today. So that's cash in my bank for the rate for them to buy it at $32.50. And then on February 6th, I'm going to collect the dividend as well. So in a month, I'm going to make 3% on that stock. Now, obviously, I can go ahead and use that money to buy other things. I can reinvest it. I can just let it sit and collect the money that Interactive Broker pays me. I can do a lot of different things with it, right? So my strategy is obviously cash flow. I want to cash flow. My goal on stuff like Intel is to make a 14 to 18% return per year. On the Canadian stuff like a Enbridge, Suncor, Canadian banks, which I'm in and out of, like the energy stuff and the banks. My goal on the banks is really to make like a 10 to 14% return per year, and that's not including upside, right? So I sell out of the money. So if it does go and it sells, like if that goes at $32.50, I'm going to make $5 per share on that, which is about a 20% gain. So I'm going to make a 23% gain on that in 2 months. Like, I'm definitely okay if that happens. Because again, I'll just take that money and either, like, I might want to get back into Intel, maybe it has an up day and it gets taken away, and then it has a down day after, and I'm like, oh crap, I'll buy more of this because it's a good dividend stock and it's one of the ones I like that I'm watching, or maybe I go to a different name. So I pick my target price and I basically sell calls at that, and say it closes at $32 that day, so my option doesn't get exercised, and the next day I might sell a $35 call or a $37.50 call, right? I'm going to keep ratcheting that up until at some point it's going to get taken away. But that is what I'm doing in the market right now. I just thought I'd put that out there because I haven't talked stocks in a while, and I am still obviously in the market in stocks, but that's the strategy that I'm working with right now. So if you guys like that, there are courses out there. There's a whole bunch of books out there you can read on this. You know, just look up covered call dividend strategy and you can find it. But you know what? Thank you so much everyone for watching. Hopefully you're having a great day, and we'll catch you next time.